All
All
right.
right. We
Go
good?
for it.
Yeah, no, appreciate everybody. This is mostly about passive income. We were talking a little bit about that before we got started, but I think there's two areas of passive income, and I'm going to focus on one that I find is a little unfamiliar to some of the real estate agents that I work with. But before I get started, if you don't know me, my name is Travis Wurtz. I'm a co-owner at Wurz Financial Services. I am a financial planner, and I specialize in working with agents. You probably know a lot of financial planners. A lot of times it goes outside of the scope of just setting up accounts. The areas I focus on are helping people do tax planning, financial planning, and managing their investments. So we want to encompass everything and help people get to a point where they can be work optional. So that's kind of been the theme on. We had a retirement class and a tax class. It's about, I think in today's world, everything's about optimizing everything, it seems like. But we want to help people make money and retire and enjoy their life. Today's gonna be about passive income. But I talk to a lot of real estate agents that you're into the real estate market. You understand. I'm going to have a class on passive income with real estate, but today I'm going to focus on passive income through your investments. And I'm not saying to pick a side. So like I've done this, and people say, well, like I like this or I like that. Like you don't have to pick a side. And I actually think it might be important to diversify. And I'll have a lot of clients that might have rental properties, and they might be investing in properties and building passive income over here, but they're also building passive income through their investments and through investing. So that's what I want to talk about. You probably know what the stock market is, but some people might not. So like, what is the stock market? If you've never invested before, the stock market, it's not a place that you go. It's it's a place that you can trade stocks and bonds and funds. I'm going to talk about some of that. It works basically through supply and demand, but it's not. It's a you can invest and buy and sell things. That's what I'm going to start with. We're going to build off of that. Um, the most simple are stocks and bonds. I think there was a point, like maybe 100 years ago or so, where people would buy, they only had stocks. And I'll run into clients where they'll have like Coca-Cola stock, from their great grandparents that they bought and held on to forever. But a stock is basically you're buying ownership in a company. Apple stock, Nvidia stock, I mean, really any company that you can think of, it's likely you can buy ownership in their company. And when you buy a stock, it's going to fluctuate in value based on how that stock is valued. If their earnings reports and certain things that will make it more valuable, the stock price will go up, and certain times stock price will go down. Bonds are kind of the opposite. They'll not really the opposite, but they'll work from companies trying to raise capital a lot of times for projects. The easiest way to understand a bond is they'll have local projects. They call them municipal bonds, and they'll issue a bond that pays an interest rate, and people can invest in the project. And they're typically considered lower risk, but they pay some kind of interest rate. Um, Now, there was a time where there weren't a whole lot of funds. Okay, so people would buy all kinds of different stocks. That's where things got complicated because 50, 60 years ago, you didn't have, you couldn't log in on your phone and buy stocks and things. You had certificates. Okay, and sometimes I'll still see these certificates. People have the certificate of stock of something. But it became burdensome. If you wanted to buy all kinds of stocks, Apple and Google and Tesla and all these different companies, you could do that, but it can be messy. Home Depot, Lowe's, I mean, what you name it. So they have all different kinds of funds. And a fund, the easiest way to put it is it's like a big bowl of soup with a bunch of different companies. So if you don't feel like buying a whole bunch of different. Oh, I like technology companies, but I don't want to go buy 100 different technology stocks. They have a technology fund that you buy one of, and you get a bunch of different companies. There's mutual funds, and there's also exchange traded funds. They're very similar. They're different in different ways. A mutual fund, you have to buy and sell at the end of the day. You can't buy it and sell it at 2 p.m. or 3 p.m. It's based on the 4 p.m. Uh, prices. The stock market is open from 9:30 to 4 p.m. Eastern time. Exchange traded funds are more liquid. You can get in and out of them more quickly, and they're typically lower cost. I'm typically a fan of exchange traded funds from a cost perspective. But I'll give you an example. This is one of my personal favorite funds. You may have heard of the NASDAQ, and this is the NASDAQ 100. You can't actually buy the NASDAQ. Here you can see some of the indexes over here. You can't buy the NASDAQ. You have to buy a fund that tracks it. So I just took a screenshot this morning. This is the NASDAQ 100. You might think, what the heck is that? And what it is Microsoft, Apple, Nvidia, Amazon, Broadcom, Google, Tesla, Costco, and another 90 companies. So this is an example of a fund. If you didn't feel like going out and buying all these companies, you could buy one of this QQQ, and there you have it. You might think, oh, so how does it do? This is the NASDAQ 100. Last year was a really good year. It was up 55%. The year before that, it was down 32. 2021, it was up 27. So, the stock market can be volatile. And that's often the risk associated with investing is the volatility. You hear people talk about 2008 and these market crashes. And a lot of times it wasn't that people lost money. You hear people talk about, oh, I lost so much money. And there were people that did lose money. But a lot of times it wasn't that they lost money. It was, yeah, the value was way down, and it did come back for those people that more or less held on for the ride. um, that gives me two index. So I showed you the NASDAQ. This is the NASDAQ 100. I just showed you here previously. You might hear these words people talk about the stock market. There's the S&P 500, which I find is more or less when somebody's talking about the stock market, they're talking about the S&P 500. And a lot of people talk about the Dow Jones, what the Dow is doing. The Dow is 30 industrial companies. The S&P 500, I'm going to show you a fund that tracks that because most of you, if you are investing, you own some of this. This is, in my opinion, the most common stock market fund. This is today. It was down a little bit earlier, but what is it? It's kind of similar to the NASDAQ. It's got a lot of companies you'll recognize: Microsoft, Amazon, Apple, Google, Berkshire Hathaway, Broadcom. But instead of if you remember that NASDAQ was almost like very heavy in technology companies. This is 500 companies, 500 of the United States large companies, spread out a little bit more. This is more or less what the S&P 500 is. It's 10-year has averaged a 12% return. This year to date, it's up 6. Last year was up 26. Year before it was down 18. I think the long-term average is anywhere between 8 to 10%. The 10-year is looking really good because it doesn't include 2008 anymore. So 2008, the market was down 55%. It ended the year down 36. So you hear about people talking about 2008, and this is what the stock market did. Now, it wasn't like I said, it wasn't like people lost money. Unless you sold it at this point. So that for a lot of the people that just didn't worry about it, and things did come back. Now, there could have been some things maybe still to be done to maybe lose less and make more, but this is more or less what the S&P 500 is. Where people get or confused is there's so many kinds of asset classes. There's real estate funds. Literally any kind of fund or anything you can think of, they have a fund for it. They have environmentally friendly growth funds. They have faith-based funds that invest in companies that don't support certain things. There's energy and healthcare funds. There's healthcare funds that invest in healthcare companies and medicine. Literally anything you can think of. There's thousands and thousands and thousands of funds. And this is where it can be difficult to know, like, how do I invest my money? I think I'm going to show you a couple strategies just to know, and things that are popular, and maybe some things you don't know. I think that the most common strategy that I see, it's often called the buy and hold, I'll call it, or sometimes it's called modern portfolio theory. It's basically the idea of, you don't want to put all your eggs in one basket. We've all heard that before. We want to diversify, to spread our risk out, because if something's doing really bad, maybe something else isn't. The only problem with modern portfolio theory is the idea is, we're going to add on bonds and other things so that when the stock market goes down, some of these other things will hold us up. What ends up happening sometimes is when the market's down, it seems like everything is down. So, like, I've made the joke about 2008, and I never met anybody that was like, "Oh, the market's down so much, but guess what? I was diversified and I didn't lose any money." Yeah, I joke about that because everybody seemed to be down something in 2008. Not that it doesn't work, but it's a way of, okay, like, how much risk do you want to take? And if you want to take less risk, you end up just making less money, more or less. It's this teeter-totter of risk. And this is what I'll see a lot of times: things stop. It's, hey, we're going to diversify your investments, and we'll check on it every year and make sure everything's doing okay. This is a good strategy, but I think there's more that to this. I'm a big fan of momentum investing. It's based on trends and rules. And the idea is, okay, if the market's going down and it's going to keep going down, maybe there's some kind of strategy we can follow to get out of the market. Maybe in 2008, instead of being down 50%, we could have been down 20 by moving things safer. So there are strategies based on momentum. This is one that I use. It's not my strategy. It's a strategy published by other people that I follow. This month, it's split up between those two funds I showed you a little bit ago, the S&P and the NASDAQ. But the idea with these momentum or tactical fund or strategies is, here's a strategy that's averaged a 16% return since 1970, and the most it has dropped is 14%. And I'll be honest with you, the first time I saw that, I'm like, why wouldn't everybody put all their money in something like this, versus in the stock market that's averaged 8 to 10%? And the reason is because there's years where momentum-based strategies like this work really, really well. Like in 2008, this strategy was up and made money. But there's also years where being in some kind of buy and hold strategy is the best place. And that's kind of the theme. There is no strategy that's the best strategy every single year. So, there's an idea of being diversified and using different strategies. This is something fun I like to talk about because not a lot of people know about it. They have leveraged funds. I'm not saying to put all your money in this, but something to be aware of. A leverage fund, it seeks to give you a multiple of the stock market. For example, 200%. So there's a fund I'll show you in a second that it tracks the stock market. When the market's up, it's up 2 times as much. When it's down 2 times as much on a daily basis. So this is a strategy that some people will use if they're more aggressive to potentially increase their returns. How can I make more money? Potentially. So here's the S&P 500 on the left. You can see today when I took the screenshot, it was down 0.2, and here's they call it the Ultra S&P. SSO is the ticker or the symbol. You can see it's down 0.4. So on the daily, whatever the stock market's doing, it's it's doubling it. So it's down zero point 0.2, it's down 0.4. If it was up 0.2, it'd be up 0.4. The idea with these leverage funds isn't to go, oh wow, that's really cool, and put all my money in this all the time, because it can be very volatile. Like in 2022, when the market, the S&P 500 was down 18%, it was down 38. However, also that would have been a really good buying opportunity potentially, because last year the market did really well. It was up 26%. So the two times was up 46. So this is something we'll often use with more aggressive people, that you maybe to have some in all the time or take advantage of some really good buying opportunities. They do have a three times as well, but I don't often show that because it's just it exaggerates the greed. I joke, but it's a really really neat tool, something that I use personally, and some strategy to be aware of. And there's also alternatives, things different than just buying a company. There's private equity. I'm going to talk about this in a second, but there's private equity, meaning companies that aren't on the stock market. Maybe there's a company you really like, but they don't have stock. You can't buy their stock on the stock market. Maybe a lot of small companies. Think about local companies around your city, like some company that's making money but they don't have stock. There's funds that invest in private equity. They're not on the stock market, but there's years where those kind of companies, private equity, does very well. There's sectors like real estate and healthcare and uh, biotech and technology. That's you got the whole stock market, and then sectors are small areas. This is one of my favorite things, just to show people they have structured products that I think at one point were really only available to people that had gobs of money. I mean, these were things that were specially made for the ultra wealthy, and now they're available to everyone. This is a structured product that was issued last December, but it's kind of like a 5-year gig, okay, where you have three outcomes. And here you can see kind of on the right. If the market is up at the end of the 5 years, they will pay out 110% of what the market did. So if the market's up 50% at the end of 5 years, you wouldn't be up 50, you'd be up 55. Sounds pretty neat. Here you can see if it's up 40, you're up 44. If it's down 20 or less, the stock market, they'll give you the inverse. So if it's down 10 at the end of 5 years, you'll actually be up 10. If it's down 20 in 5 years, you'll be up 20. And if it's down more than that, they'll absorb 20% of the losses. So maybe in 5 years, the market was down 21%. Well, you would only be down 1. Kind of an interesting idea. And the reason they can do this is because it is a 5-year gig. You can get out really anytime, but to get those full benefits, you would need to stay in for 5 years. This is something that I think is pretty neat and not a lot of people know about. But to be able to make more money than putting all your money in the stock market while also having some risk management or a buffer, pretty neat stuff. It's all going to boil down to what is your personal risk tolerance. Everyone has their own risk tolerance, and it can change. It can change over time, and it can change just through your experience. How aggressive or conservative are you? And you might think you're more aggressive than you might actually be, or more conservative than you might actually be. This is going to determine how you will invest your money. Some people, they just can't handle the volatility. Things are up and then down, and then up and then down, and that stresses them out. Some people, there's look, I'm in it for the long term. I got 20 years. It doesn't matter what happens the next month. Some people are more long-term thinking and aggressive. Taxes are a thing that will never go away. And this is going to be true with anything. You buy and sell a house, on your investments that are not retirement accounts. You'll have short-term gains. So if you bought, let's say you bought Apple and you sold it in a month, anything less than a year, if you bought and sold, it's a short-term gain, it's taxable just like income. Anything that's after a year, you buy something, you're like, I'm going to wait until 366 days and then sell it. Anything beyond a year is a long-term gain, and they have their own tax brackets, which are lower typically than your ordinary income. They're tax advantages. Some funds pay dividends. They're oftentimes just taxed at an ordinary income. And if you have a retirement account, there's really two kinds of those money. We talked about this in our tax video a couple weeks ago, or whenever that was in our retirement one. But your pre-tax, or maybe like an IRA, you're going to save income tax when you put money in and pay it on the way out. So are your tax brackets higher now, or higher when you're going to be taking it out, lower? Or there's Roth, which is you don't save anything to put it in, but it grows 100% tax free. They're both considered tax deferred, but I would really take the Roth out, and it's not tax deferred because there is no paying it later. It's tax free. I always say it's the only place you can make money and not pay taxes. You can make as much money as you could make $1 billion in a Roth, and you'd never pay taxes, and it's pretty incredible if you think about it. So it's going to boil down to what are your goals? Are you somebody that you want to grow some nest egg for passive income? Are you looking to invest for something more medium term? What's important? And these are something that you want to think about. How many years do you have to build some kind of passive income? All of these things have fees and expenses. And I think there's a saying, ignorance is bliss. Just not going to worry about it. Well, just do the thing. But I think these are things to be aware of and also look at every year because they change. All of these funds, I'm going to swing back. All of these funds have their own expenses. This S&P 500 fund, the expense ratio, you can see, I don't know if you can see where my cursor is, but it's on the bottom right. Expense ratio, 0.09%. One of the reasons I say I like exchange traded funds is because they're often very low cost. There are growth funds from other companies that more or less have the same companies in here, Microsoft, Amazon, Nvidia, and their expense ratios are sometimes 0.8%, 1%. And I often think to myself, it's the same soup with the same ingredients, more or less, but it's costing more. So it's something to be aware of. I'm going to fly back. There we go. Every fund has their own expense. A lot of times people forget about it. I've met with people, and they're paying somebody to manage their money, whatever, 1%, and then their funds have 1%, and then whatever platform they're on. A lot of times platforms have administrative fees or trading fees, and this stuff can really add up. Now, there are platforms that have no admin fees and no trading fees. Charles Schwab is one of them. And if you have an advisor, a lot of times they'll either make a commission or some kind of management fee. These are two separate sides of the business. Some advisors sell products to make a commission. Sometimes things have surrender fees, meaning you have to stay in them for a certain amount of years, or there's a fee to get out. Other advisors charge a management fee to more or less regularly manage assets. Beneficiaries are, I'm going to talk about bank accounts too, because if you have bank accounts, a lot of times the banks aren't very good about making sure there's beneficiaries. I've been caught in this too. When I set up my business account, they just never asked me. Maybe that was just Fifth Third Bank. But all of these accounts, and investment accounts, and your bank accounts, you want to have a primary beneficiary. If something happens to you, who do you want the money to go to? So it doesn't go through probate and cost a bunch of money and attorneys and court and yada yada. It's a good idea also to have a contingent. So if you're married and have kids, you could put your spouse, and then your contingent would be your children. I think it's a good idea anyway to have a contingent. And that would be for something happened to you and whoever you want the money to go to. Who would it then? Who would be the next step? You can leave money to minors. My kids are 2 and 3. Uh, it can become complicated then because you have minors inheriting money. How that would look is it would go into a custodian account where there would be some named custodian, like a family member, that would kind of be signing on the account until the minor is of age. I love when they have this little box that says per stirpes. Maybe you've seen this, but you didn't know what it was, or maybe know what it is. There's a per stirpes option, which means it follows the bloodline. So if you have 10 kids and you didn't feel like listing all 10 of your kids as contingents, you could say, I'm leave it to my spouse and check that box. And that would mean if something happened to you and your spouse, it would just follow your bloodline. If you have 2 kids and you listed your 2 kids and then you had another kid and you forgot to list them, the nice thing about per stirpes is it will just always follow the bloodline. If you passed away with your spouse and one of your kids, it would continue to follow the bloodline to like your grandkids. If that was a thing, you can leave a trust as a beneficiary. Some people have trusts set up. This is important, really, really, really important thing to have set up, especially on bank accounts. So check that out. Go to your next time you're at a bank, say like, hey, do I have a beneficiary on here? And like, is that set up? So the most important, how can we build wealth and passive income through investing? And like I mentioned earlier, this doesn't have to be pick a side. I don't think you have to pick, am I going to dedicate my money here? Am I going to dedicate my money to my business? Am I going to dedicate my money to building passive income through rental properties? I think they can all work together. The power here is through compound interest. Everybody's heard of compound interest. You know how it works. The more money you have, the more money you can make. That's basically how it works. The rule of 72 is pretty neat. I can't do like a show of hands because I can't see anybody, but maybe you've heard of this before. It's basically will tell you how long it takes to double your money. So your doubling time equals 72 divided by interest rate. So let's just say you could make 10%. Easy math. If you can make 10%, 72 divided by 10, you would double your money in 7.2 years. And the opposite. So if you could make 7.2%, you double your money in 10 years. So you can divide this any way you want, and it's just kind of an interesting, fun thing. Oh, wow. Oh, look at that. I just need to click a button. I had them all in here. 14%, you double your money every 5 years. That's pretty neat. So you can kind of see the more money you make, obviously, the quicker you can double your money. This would be an example of simple interest. You got $100, making 10% a year, 10, 20, 30, 40, 50, 60, 70, 80, 90, 100. $10 a year. Compound interest, the first year you make the same amount of money. Now that second year, you're making 10% on $110, not $100. So your interest is 11. Is it not 10? Not a big difference, but that continues. Now your interest is 12 and 13 and 14, yada, 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 to the point where, in this last year, it's not $10, it's $24 in interest. And that continues to grow and magnify. This is a strategy of saving money, which is dollar cost averaging, and it's regularly adding to your investments. It's not, I know that's difficult to do when your income it fluctuates, but I encourage people to, set something up, treat it like a bill, and then, if business goes really good, we can add more. Regularly adding in, and what ends up happening is you actually lower your average price because you're buying when things go up and you're buying when things go down. Um, try to work it into your budget. I've had some clients where the market's down and they're like, "Okay, Travis, I want to cancel that $500 a month going into my account." And you don't want to do that. It's totally the opposite of what this is trying to achieve. You really actually, what you want to do to the opposite. You want to increase it when things are down, because then you're buying the market on sale more or less. So these are fun to play with. If you ever, I think I've showed these in all the times I've been on here, but in an investment calculator, we can look at, you got 10 grand, you got 25 years, you can make 10% a year, and you're going to put in $1,000 a month. Okay. There you go. We can create potentially, if you could do that, 1.3 million in 25 years. Now somebody might say, "Oh, that's not a whole lot of money." I think $1 million is a lot of money, especially when you put in 300 grand and you made a million in interest. And you could do it in a way through a Roth where the whole kit and caboodle is tax free. You can take all the money and buy 25 Honda Odysseys, and you tell the IRS, "Hey, I owe nothing." That's pretty sweet. I like a more fun example. Maybe you got 100 grand, you borrowed from your spouse and told them you were starting a business and then you invested it or something. Or maybe you have it from an old employer or something like that. Just make a joke. Let's say you got 100 grand, you got 20 years, you can make 10% a year, and business is cooking. You're like, I'm gonna put away 20 grand a month. I'm gonna just make this my bill. 20 grand a year, not a month. That would be pretty nuts. Okay, you got 100 grand, you're saving 20,000 a year. Um, you could create almost $2 million in 20 years. This is a lot of money. You put in 400 grand, you made 1.5 million. Now this is where the power of compound interest really shows. So you got 20 years. What happens if we add another 5? Just another 5 years. Your 2 million goes to 3.2. Like 5 years, we made another 1.2 million potentially, right? Same thing, just add another 5 years. What if we go another 5 years? Okay, we got 30 years. Your 3.2 million is 5.3. Like that in the next 5 years, we've made 3, 4, 5, like $2.5 million. Like we've made more money in those 5 years than our first 20 years. And that's the power of compound interest. It took 20 years to create $2 million. And here we just, basically increased by 2.5 million in 5 years. So the power of compounding is bigger than just, oh, like I'm going to make my 10% on another dollar, right? Like that previous example. It's the power of doubling your money. And I've watched this with the clients. It's taken them 30 years. Nobody wants to think about 30 years, but I've seen clients taking them 30 years to create $1 million. They didn't make a ton of money, but they saved as much as they could. It's like I've got $1 million. And then in 5 years, it's 2 million. So wait a minute, it took me 30 years, my whole life to create all this money, and I doubled it by, doing nothing. And that's passive growth. It's money at work. You have people at work and you have money at work. And it's the most beautiful thing. And going along with that, I'm going to skip this, is passive income. Actually, I will talk about this. Having patience, sticking to the plan. And I think this is where a lot of people go wrong. They think, oh, yeah, the market's up 20%, I'm only up 18. Something must be wrong. I got to change something. Or the market's down, and I got to change something. And a lot of times, we live in this world where we always need to be changing something. And sometimes you just need to stick to the plan. There's going to be good years, there's going to be bad years. It's very difficult to leave your emotions out of your investment decisions. People oftentimes say, "Oh my gosh, I'm never gonna." I've heard this before. It's like, "Travis, I'm old. I'll never be able to make this money back. We need to put all our money in cash." Just, it's important to have patience. You're not trying to outsmart the market. A lot of people will say, "Oh, gotta do this, gotta change this." Just having your eyes on the prize. Long-term investing takes time and takes patience. I'm sure you've met people that have made a lot of money very quickly. I have too. But the people that I know that have the most money, they didn't do it overnight. And a lot of their money came from stuff like this. Anyway, we got a guy, Johnny Boy wants to retire in 20 years. He thinks he can make 10%. His business is cooking. We're going to save 15 grand a year. In 20 years, John would potentially have $1 million. Sounds good to me. If he waits another 6.5 years, he'd have 2 million. Look at that. Good job, John. So we got John, he's got a couple $1 million. Now, how do you generate passive income? I'm going to go back to that example. So I didn't just like talking about John. But this is really the key. Like people will say, why do you have so much money? are some of my clients, and maybe like you have one client that's really in investing, and maybe they have a spouse that's just as let them do their thing. Like, why do you have so much? Why do we have so much money? And the reason to have the money is to feed the money machine. And this is what it's about: is building a money machine where you have money and you have income. And if you're really smart, you have tax-free income. So generating a passive income from investing, you could go out and buy an annuity where you're trading your money for an income. I'm not a big fan of annuities, but people do that. You can go out and buy a fund that pays a dividend, your old Coca-Cola stock, and live off the dividends or something like that. I'm not a huge fan personally of that kind of strategy. I like a withdrawal rate strategy. That's what I'm going to be talking the most about, um, which is how much can we take out of our account to allow it to keep growing potentially and feed us an income. Now, you couldn't take out 20% a year. Well, you could, but you probably run out of money in 10 years, right? Like, do the math. So, what is an acceptable withdrawal rate? And the idea is to come up with something, maybe 4 to 6%. Maybe I'm taking out 6% per year, and I'm growing by maybe 6 to 10. So, okay, I'm still growing this money, but I have an income, and it's flexible. It could go up, it can go down. We can maybe you want to buy 100 Honda Odysseys, and you take a bunch of money out for that. You want to increase your income because inflation's gone crazy, uh, and taxes. It might be taxable if it's all in a retirement account, or if it's in a Roth, it might be tax free. So I'm gonna give you an example. We got a guy, John. He's got $1 million. He does not plan to stop working. However, business is slow, and he wants some passive income to help with his life. So how much income could you pull off of $1 million? Well, the good thing is it's easy math. So 5% of a million is 50 grand a year. You could take out 6%. You could take out 7. You could take out 8. It would just make it a little bit more risky the more you take out. But he's like, hey, could I take out 50 grand you know, and would that hurt me? John could potentially pull out 51,000 at a 5% withdrawal rate and allow his investments to keep growing. Now, maybe a more fun example is looking at this. You get 100 grand. You're like, I want a 25-year plan. I'm going to put away 20 grand a year. Boom. Okay, I'm on the track to create 3 million bucks in 25 years. And the point of all this money is not to just have it. The point of the money, like I said, is to feed the money machine. You take a 6% withdrawal rate from 3.2 million, you've got $192,000 passive income. If you do it right, you could have $192,000 tax-free passive income. Like, wouldn't that be something? I've got clients that are doing this. I've got people taking 20 grand a month, and like they owe the IRS like zero. And then you get Social Security, whatever. Like if it's around, so this is a passive income strategy. It does not happen overnight, and that's where maybe you're on the path to do rentals or your business. I think that this is a piece of it. Maybe not all of your income comes from here, but I think that it can work very well as a long-term passive income strategy. So anyway, that's all. I think I ended it a little quicker. I didn't want to have you listen to me for an hour like last times. But I will put my email in the chat if anybody has questions. I know we like zoomed through, so if anybody has questions, feel free to. Yeah, thank you.
Are
Thank
there
you.
certain like is there a certain way for somebody who's brand new starting out? Is there a certain plan that you typically give people?
Typically, if somebody has not invested before, unless they have absorbent amount of money in cash in their bank or something, I like to start with a non-retirement investment account, something that's liquid. Especially if you're a realtor and your business is up. Like, hopefully we don't need the money, but it just really sucks if you're like, I'm gonna grow, and you go through a really bad year and you need to pull the money, and then you're like paying penalties because you're pulling from a retirement account. So, like, ideally, I would love to have all my clients have like 50 to $100,000 in an account It's not a retirement account, but they can access it. Like they can shoot the money to their bank if they needed to. If not, like it's just growing. And not even for a business, like I'll give you like buying a house. Okay. Like I have an account like that. And it's like, okay, I need to buy a house, but I don't want to, like, I have two kids, right? So we were moving with a kid. Like I have a 2-year-old and a 3-year-old. And when we were pregnant with our 2-year-old at the time, we moved and it was like, okay, I don't want to sell my house and then buy, because I got to stress out about, okay, I got to find something in whatever my days. So having an account like that that's liquid could be like your bridge. Okay, I'm going to take out 50 grand and use it as my down payment and then feed it back when I sell my house. Just having the ability to like temporarily use your money, because I'll tell you, I've had clients that all their money's in retirement and they don't have any money like that's in a non-retirement account. Oh, the bank told me that if I take my money out of the retirement account, I'll be able to get a home equity line or whatever and put it back into my retirement account in 60 days and avoid the penalty and taxes. And I've had 2 clients take that bet and they've never won. Like, it's always, oh, they didn't put the money back in time and then they get charged taxes and a 10% penalty on the money. So very long answer to your easy question. Yeah, I like to start with just a normal investment account. You get 10, 20 grand, something like that. Then really start thinking about Roth or retirement. That makes sense?
Yep.
Mm-hmm.
That's just kind of my advice, but yeah.
Cool.
Thank you. Does
Yeah,
anybody
thank
have any
you.
questions for Travis? He's become a regular on here at
This
this
is the
point.
last one. Like you said, last one was the last one.
I know, and I was wrong.
Like,
It was great. Yeah, this was really good. Thank you.
Yeah, we can do it again too, because maybe later I have some other classes I'm putting together on like, we did one on tax savings, but I have another one on like tax planning, more like lifetime tax. Because I don't know about you, but I'm not into the whole pay millions of dollars over my life. I mean, everybody here that's listening, you're gonna pay over $1 million, okay, more than $1 million in taxes over your life. And like, what if you could pay $1 million less? You know? So yeah, those are things that I'm looking at. I'm like, I don't want to pay millions of dollars in taxes over my life. I'd be like, if I could pay less, and not that I'm trying to rip off the government, but hey, nobody likes taxes that I know.
Sweet. When's that call gonna be?
Yeah, well, hopefully soon. Like I just got to put it together. I'm in the process, so.
Yeah, we want all the tax information to keep us from paying.
Is that the hot topic with all the realtors? Is how to avoid taxes?
I think that's everyone.
Well, you don't have
nobody
to pay
wants
them,
to
but
give their money away.
What's that?
Nobody wants to give their money away.
I know. I hear you. So.
Well, let us know when that's ready and we'll get you back on again.
Yeah, no, that sounds good. And thank you all for, I put my email. If you have a question, you can I know we zoomed through, you can feel free to send me an email and thank everybody.
All right. Well, thank you, Travis. We'll see you again next time. And Nikki and I will be back here next week for my birthday. And we are going to have another Modern Agent Blueprint next week. Nikki and I will announce what that topic will be shortly. We're trying to coordinate with somebody. So we'll let you guys know who it's going to be, and we'll see you all then.
Thank you.
All right.
Thanks.
Bye, everyone.